Nifty is at. The Sensex is at about 72,822. So, these are opening first rates coming through. Oil marketing companies, perhaps, first off the block, which should be in focus, along with a few others. BPCL is starting about 4% lower. HP is down about 5.5%. HP, of course, as Sonal was also pointing out, perhaps hit the most. IOC is down about 3.5%. Oil India is higher. Advanced decline is okay. Too early to look at it in any case. Bank Nifty, though, is like yesterday. Bank Nifty was the underperformer. It is down about 0.25%. But Sonia is on the wall with more rates. Sonia.
Okay, so since you started off with, the Nifty Bank and the pressure we're seeing there, also take a look at the Nifty 50, which is now just hanging on to the 22,000 mark by the skin of its teeth. Oil marketing companies, right? You pointed that out, so I just want to get straight to that. All three oil marketing companies are down anywhere between 2 to 3% as the government has cut petrol and diesel prices by 2 rupees a litre. So this is definitely sentiment negative, and there could be more pain in store on the margin front. Paytm, that one is reacting to positive news flow. The NPCI has now approved Paytm to participate in the UPI as a third-party application provider. So that, approval is a big positive for Paytm, 5% higher over there. NHPC is in focus. In fact, both NHPC and JSW Energy have received a letter of interest from the Gujarat Urja Vikas Nigam Limited. For NHPC, it's for a 200 megawatt capacity solar power project, and for JSW Energy, it is for a 300 megawatt solar power project. So just keep an eye out on these two stocks. In fact, talking about order wins, BEL is in focus as the company has won an order worth 1,940 odd crores. The stock is up. The stock is flat actually with a bit of a negative bias. L&T Tech has bagged a cyber security order worth 800 crores from the Maharashtra State Cyber Department. I'm also looking at some of the technology stocks this morning because there is a report from CLSA where they have reiterated their cautious stance on the IT space. They have a sell rating on Wipro, on HCL Techs. All of these stocks are a tad bit under pressure. Nothing alarming there. LTI Mindtree as well. Wipro, HCL Tech, TCS and LTI Mindtree. This is the cautious stance that they have on these stocks. Axis Bank also on my radar this morning as Nomura has put out a report. They have a buy call with a target price of 1,250 on Axis Bank. But otherwise, the market opening is not as bad as what we saw on Wednesday. But anyway, the Nifty is still down about 50 odd points, hanging on to the 22,000 mark. Back to you.
Well, thanks a lot for that, Sonia. Well, keep an eye out on the broader markets. We had Mr. Sandeep Tandem earlier today of Quant Mutual Fund, and we had asked him about Swan Energy. He didn't answer that question particularly, but there have been investors out there, and he said he's positive on the theme on the whole. That stock took a sharp knock. In the last 5 days, it's down close to 25%. Today, it's bounced up close to 7%, and it's one of the top volume traded stocks. So keep an eye out on that one. You have the other one, Paisalo Digital, which is up close to around 8%. So that's popped up in style in today's trading session. Railtel, that stock is up close to 6.5%. When we saw a bit of a correction, that stock got hit hard. Last couple of sessions, it's pulled back a considerable bit. Capacite Infra, stock up close to around 6%. So that's coming out with one of the top volume buzzers. Let's pull in a few more. RK Swamy, the recent listing, had a subdued listing. That's up close to around 6% as we speak. So that's a fair bit of stocks that are moving around. And I think Shakti Pump's very low volumes out there. But you have Gopal Snacks. It had a subdued listing yesterday. It was down close to around 5% by the time we wound up. It opened up with a cut of close to around 10%, Gopal Snacks. But that stock as well has bounced up close to around 5%. You have Quant Mutual Fund. That was one of the buyers in yesterday's trading session. Prashant.
Well, so it's a 50-odd point lower start on the sort of Nifty, and the Bank Nifty is absolutely flat. It's got a 40-odd point change, so nothing at all. And I think the small cap index and the mid cap indices is positive. The small cap index is up 0.5%, and you've got the mid cap index, which I think is also starting up about 0.4% or so. So broader markets, I think that's what matters, because the problem has not been in the large caps at all. It's been with broader markets, and there the recovery continues, at least in the word go. Small cap index is adding a little bit more in terms of gains. Just a few more names. So the PSU and railway stocks all bounced sharply yesterday. That continues, right? IRFC once again figures as one of the top volume gainers, 3.5 higher. Railtel is up about 7.5%. Exicom, which is the recent listing, was up 20% yesterday. It's up 9% this morning, and huge volumes. IRB did very well yesterday, 4% on IRB. Campus Shoes, that is 5% in the green, 231. KPIT Tech, I think we mentioned, 3% gains. Phoenix Limited, that's the mall operator, 2.5 higher, 2,700 on that one. Gopal Snacks, we just outlined, 4.5 in the green. Capacite Infra, that is up 9%, 250 on that one. So strong gains coming through. Lodha is up about 3.75%, and that is coming through with significantly strong performance as well. On the downside, there is not very much. Suzlon is down 1.5. Electra is down about 2.75. Electra is coming up with very, very large volumes as well. So that is the sort of odd one out. But the top three volume-led losers are all oil marketing companies, which are down between 2.5 to about 3.5%. So that's the overall picture. Markets down about 70 odd points on the Nifty. Our market master of the day is Vetri Subramaniam. He's Chief Investment Officer, UTI Asset Management Company. Vetri, great to have you with us here as always. Good morning, Prashant this side. We're speaking out of the last few days where we saw a fair bit of volatility, unusual in the as far as the recent history is concerned. I should say not used to, because we're used to very trending up markets. So a stark and, in a way, timely reminder that markets don't just go one way. How would you read the overall situation, Vetri, now with this shakeout we've seen in the broader markets?
Well, a good thing about the way we work as mutual fund managers is we don't have to react to what happens to the market every day. But certainly, I would say, right through, I would say somewhere around December through Feb, the markets were pretty much on steroids. I think there's a little bit of a lull now coming in. And that's a good thing, because otherwise the valuations were starting to get very punchy. And that does, create its own challenges for investing. But I think, might be a little bit of the fluff is getting taken out now. And, hopefully things will look slightly more stable. As you rightly said, Prashant, I would actually strongly suggest to investors that they should be guided by past history of volatility in the markets. Drawdowns of 10% once a year are very common. Drawdowns of 15 to 20% are very common once every 3 years. And drawdowns larger than that are common once every 5 to 10 years. So as much as we've got this wonderful, pipeline of SIPs coming through from investors, and, many of them are investing for the very long term, this is not the kind of volatility that should start to scare you. This is very much par for the course. And that's the main message I would want to convey to investors.
Okay, that is a very important message to pass on, right, Vetri? Because you and I have both seen so many of these market cycles where such volatility is not just par for the course, it's actually quite healthy to get the froth out of the system and to make the market light again. I wanted your thoughts on how retail investors should approach it from here on. Do you continue your SIPs? Do you continue staying, sort of invested in equities, or do you move to other asset classes? Because there's a lot of money being made in asset classes like gold, cryptocurrencies, even real estate for that matter. Your thoughts?
Sorry, I think, thanks for asking that question. I think it's always useful to remember that eventually there's a whole bouquet of assets that you can choose from. And it is appropriate for investors to, first of all, have an asset allocation framework. And when we say asset allocation framework, it does not mean positioning yourself in the asset class that will do best over the next 1 year. It's the set of asset classes which over a 10 to 20-year period will help you achieve your financial goal. So please do not understand asset allocation as being, I'm going to pick the asset class that will do best over the next 1 year. You're setting yourself up for disappointment. I've been here for 30 years and I haven't seen anybody figure out what will be the best asset class on a rolling basis, on an annual basis. So it's really about staying the course and having that diversification across asset classes. The main point that I would, sort of build on what you said is that the market does provide you an opportunity every now and then to rebalance your portfolio, right? So maybe when you did your asset allocation framework in line with your financial goals, maybe you had, just for argument's sake, a 60% equity allocation. Now, because of the market movement, you could be higher than 60%, you could be lower than 60%. The way to think about it is that at some defined frequency, or when your allocation moves very significantly away from the baseline, you rebalance to the baseline. So it's a combination of having asset allocation and rebalancing at some frequency, which I think is the key to being able to sleep well at night despite volatility. And believe me, that's the biggest challenge that I find investors experience.
Oh, put it so beautifully, Vetri. Thanks a lot for joining in, and good to hear those comments as well. Well, Vetri, I wanted to ask you about the financial sector, particularly in the backdrop of the regulatory action that we've seen from RBI on select NBFCs, whether it's gold, whether it's on lending as well, and unsecured lending in particular. How would you view this? What's your take?
Sure, Nigel. Well, I think it's good that the regulators are sort of being preemptive. They're being active and not reactive in terms of taking some of these decisions. The central bank's job is always to sort of make sure that things don't get out of hand, because remember, financial stability is a very important criterion for the central bank and for the economy to be able to achieve its medium to longer term growth objectives. So I see this literally as the central bank doing what it needs to do. Look for pockets where it thinks something has gone out of line. Look for areas where they have a very elaborate process of annual inspection of all sorts of lenders, and then when they see some patterns over there, maybe they are responding to that and they are starting to preempt. I will, however, say that when I look at the more longer term data, right, and I prefer to go back to pre-pandemic period. If I look at the pre-pandemic period to today, credit has grown slightly faster than GDP, nominal GDP over that period, but nothing which really raises any red flags, so to speak. I think looking at credit growth for the current year relative to nominal GDP makes it look like, oh my God, credit's growing so much faster than nominal GDP. But I would suggest, the last 3 years, the year-on-year numbers are all over the place. It's best to go back to, the quarter ended March 20 and look at it from there. And when I look at that pattern of credit growth versus GDP, I don't see anything systemic which is showing up, but the RBI has better access to data and they are perhaps acting where they thought it necessary.
Vesri, how does I know this is sort of slightly over the next couple of months, and markets, of course, will look beyond, and these events come and go, but we're into elections now, right? Election season, proper election season. What's the kind of roadmap you'd kind of expect because of how well the market's broadly done? Do you think, and especially the PSU space, we get so many questions going into elections. What is the, how do last couple of elections, how did PSU as a basket do, especially under this government where there's been so much improvement operationally and otherwise? Just your thoughts, markets into election cycle and PSUs as a space.
Prashant, that's a really difficult question. First of all, it's very hard to figure out how markets will respond to elections. I've been, watching elections actively as an investor in the market going back all the way to 1996. And believe me, every time the market surprises you for two reasons. One, sometimes the election outcome itself is a bit of a surprise. And secondly, sometimes the market reaction on the day of the outcome and what it does 6 months later is diametrically opposite. Right. So my simple advice to investors is don't focus on these events and the outcomes. And I think this time, certainly, looking at all the data, you guys put out a massive opinion poll, right? It all suggests that, the outcome is not going to be so much of a surprise. It could be the seat count, which is a bigger issue. So I don't think the elections per se this time are that sort of a destabilizer. Second part of your question as regards PSUs, I would just say that I have never liked to look at companies purely from just ownership perspective, right? I mean, I don't look at things saying I should buy all Tata companies or all Birla companies and so on and so forth. And therefore, neither do I look at it from the point of view of, just going on.
Oops, I think there's some issue with that video. It's frozen there. We'll get back to Vetri in a bit. But for now, the market is quiet, and I think quiet is good. The street would definitely like quiet, given what we've had in the last few days. The Nifty is just hanging on to 22,000, just catching its breath. A little bit of a pickup after the early morning fall that we've seen. The mid-caps actually in the green, which is a good thing. And you have a lot of support coming in from FMCG names. There's Britannia, there's Titan, even banking names. SBI is up in the green. And then, some of these metals which really got battered in the last few days are coming back. So JSW Steel is something that is looking good. But let's do one thing. Let us move on. We'll try and get back to Vetri in a bit. But for now, we'll also focus on some of the IT companies. LTIMindtree is the stock on our radar. The company has entered into a joint venture with Saudi Arabia-based Global Digital Integrated Solutions, in which the company will invest almost $12.5 million for a 51% stake. To discuss more on this development, we have Sudhir Chaturvedi, the president and executive board member of LTIMindtree, joining in. Sudhir, thanks a lot for joining us this morning and being a part of our discussion. First, on this particular agreement that you've signed, can you tell us a little bit about what is the rationale on this? What is the opportunity that you see for the company?
Sure. And good morning to you, and thank you for taking the time today. We are very pleased that Saudi Aramco, which is the world's largest oil company, selected LTIMindtree to be its JV partner to set up this. What is a path-breaking JV for them, in terms of setting up a JV for IT services and digital solutions that to be provided initially starting with in KSA and then further on to the MENA region. Now, just in terms of market size, the KSA market size today is approximately about $14 billion, but it's growing very, very fast right now. It's the fastest growing technology market there. And the overall MENA market is about $60 billion. So we expect that this overall market by 2030 will be close to $140 billion, and easily, as I said, the fastest growing market in the globe. And the rationale for this JV is to essentially bring the synergistic capabilities of the two companies. Aramco with its obviously it's the powerhouse in Saudi Arabia and extremely well known across the MENA region. So they will bring essentially their connects within the business community, and LTIMindtree will bring its capabilities and its essentially its solutions and tooling to the JV. Just in terms of the amount that you mentioned, that's only for year one as we set up the business, but there is a plan to keep investing further in it because a key tenet of this is to create a local IT services company. So there will be significant presence in Saudi from a localization perspective. We will be setting up regional hubs in Riyadh, in Dammam, and in other places as well.
Got it.
So huge investment over the next 10 years from both sides to make sure that that we create essentially the premier IT services company in the KSA.
Got it.
Region.
Got it. And I understand the potential. I mean, Riyadh is the big hub right now as far as investments, global investments are concerned, ever since the opening up of the economy. So I get that. But just to understand, this is basically you're trying to increase your presence in the MENA region. How much does the MENA region contribute to revenue right now? What is the kind of growth that you're looking at from that region over the next couple of years for your own business?
So, I think at this point, the MENA region is part of our overall, essentially what we do across India and Asia Pacific, but what we are now doing with this JV is creating a specific entity that is focused purely on MENA. We've already had a very significant presence there. In fact, we've built on the back of the L&T Group. The L&T Group has a very strong presence especially in Saudi Arabia, and they've a very large order backlog, as you're probably aware of, in the region, as well as they've set up local offices, local factories. So what we're doing is we're building on the legacy that L&T Group has created to do the same thing from an IT services perspective. As I said, we already have quite a significant business with Aramco themselves, with the banks in the region, with insurance companies in the region. And now together we're looking to target the ministries and the giga projects. So projects like NEOM, Red Sea Global, there are various, there are at least 20 giga projects that are underway, and each of these will require very significant investment in technology. So that's the combination that we're going to bring together to start with, essentially with energy, BFSI, giga projects, and government ministries. We'll start with KSA and then expand to the MENA region.
All right. Hi, Sudhir. Good morning. Good to see you in. Nigel on this side. But could you give us a number as a percentage of your total revenue mix? How much does MENA contribute? And since it's growing at such a fast clip, where do you see it headed?
Well, we don't, disclose specific by geography, but what I can tell you is that, for us, the India and Middle East, the Middle East market has always been a very significant market. As I said, we built on the legacy of our, of our parent that has always been very strong in that region. I think we are probably, if not the largest, certainly among the top two in the region already. And those credentials were very important in terms of us being chosen as this JV partner. Because I think what they wanted to see was commitment to the region. How much is someone willing to commit to the region in a way that we can jointly develop a completely new digital infrastructure for the country and then expand beyond it.
Okay, all right. So you're giving us more qualitative details rather than quantitative. So we'll stick to that. How's the quarter shaped up, though, for the company on the whole? Quarter three, I think you all had hinted that it will be better than quarter four will be better than quarter three. Has it shaped up on those bases?
I think we said that quarter four will be similar to quarter three is what we had said during our earnings call in Q3. I think we were continuing to see that. I mean, we continue to see caution in the environment. In fact, in all markets except perhaps the Middle East, where we are seeing sort of easily more than double-digit growth in that region, and that's partly one of the reasons why we are investing so significantly there. I think one part, Nigel, that I'll add is to partners of ours like AWS, like Microsoft with Azure, and then Google. All of these guys, SAP, Oracle, ServiceNow, they're extremely excited to see us making this kind of investment commitment to the market because they need a system integrator that they can work with on all these major programs. And we are the first mover here. And clearly, as I said, once you have a tie-up with Aramco and that to a JV, and this JV was blessed by both boards, right? So, imagine the Aramco board blessing the JV. So this is that significant. And I just want to make sure that, this was one of our key objectives in Q4 was to get this deal done. And we're very happy with that. In terms of the overall environment, I think, we're going to continue to see caution, but I do see some green shoots starting, but there is ways to go there.
Okay, Mr. Chaturvedi, hi, good morning. Just to zoom out a little bit, when that L&T Mindtree, the merger happened, LTI Mindtree, at that point there was indication given that there could be the potential synergies worth about I think $1 billion and 200 to 400 basis points improvement in margins over the next 4 or 5 years. We are still early into that, right? I think just about 2 years in from when that kind of guidance was given, broad guidance was given. Are we kind of broadly still on track for that? Or do you think the environment perhaps has turned a little bit with discretionary spends, etc., looking uncertain, as you've highlighted during your quarterly meetings?
No, actually, yeah, you're right. I mean, in terms of, the plans that we have for the LTI Mindtree, the business case that we had for the merger, that is still, maintained. What we are seeing, in fact, I would say point out to 3 data points, right? If you see our order book, our order book continues to, grow significantly. We're now at around $1.5 billion a quarter in terms of order book, which is a good 25-30%, or in some cases 40% premium over our quarterly numbers. And the other aspect of that is that, we're actually being invited to a very significant number of large deals. So, which was the other merger thesis that, we'll get to play in a larger pond. And we've got just over $4 billion worth of large deals that we are currently bidding at. And the third thing was that partners, the large tech partners, the hyperscalers, the other the SaaS providers, the ERP companies they would see us in a different light with the scale that we had. And those 3 synergies have already materialized. Now, in terms of revenue growth and margin, yes, the impact of the market has been there. We've faced it as well along with our peer group. But I think, as the market returns, because we've got some really strong fundamentals in terms of, as I said, order book and large deals. And the last but not the least, our customer satisfaction is extremely good. So post-merger, our first priority was to make sure that our clients saw no disruption at all. And that's something we've achieved and achieved really, really well. So in fact, our recent CSAT dipsticks show that clients are extremely happy with the way the merger has been executed internally because they've not seen any disruption. And frankly, that was step 1. And then, as I said, building on the rest of the merger thesis.
Just one other point. Is it maybe because of the environment, but also because your exposure to what we call discretionary spends is higher? Is that perhaps one reason why growth over the last, say, 4 quarters has been a little tepid? I mean, is there an additional point? And what can you do in terms of adding to your service offerings? Maybe greater sort of inroads into the ER&D space, Is there any change in direction that needs to happen, or you're well set? And it's just the turn in environment which will sort of help you. Yeah.
Yeah, I think what we have seen is, the discretionary spend has slowed down. That does impact projects in digital engineering, in e-commerce, in customer success. The kind of programs that were essentially designed to drive revenue growth have been, sort of the spend on that has reduced, and that has had an impact on us. Now, in terms of us, looking to make sure that, we've got a good balance between annuity revenue and project-based revenue. This is where the large deal footprint comes in. So amongst, I was talking about the $4 billion plus pipeline that we have in large deals. That's about 80% of that pipeline is annuity revenue, which is cloud, infrastructure, security, applications, data. So these are the areas that we are already seeing a lot more traction in terms of large deals. So the book of business is already balancing in terms of more longer term annuity deals, and we'll see the benefit of this in the coming years. But we want a good mix, because what we do want to do for clients is to not just save the money, but also to be able to make sure that we leverage those savings for true digital transformation, because most clients have actually slowed digital transformation down. You cannot stop it. You have to continue with that process.
Got it. Mr. Chaturvedi, love to go on, but out of time. So thank you so much for joining us and taking us through that conversation. Good luck to you, and hope to speak with you soon again. Thank you. We'll take a quick commercial break here. We are back. We've got a discussion lined up as far as the railways sector is concerned. So that's coming up in just a bit from now. Markets holding on. The markets turned and turned sharply. The indices will tell you that Nifty is down 115 points, but the broader market is where the turn has been even more significant. Small cap index is down 0.4, and the mid cap index is down almost 0.7%. So very sharp turn on the way down. Market breadth is now negative. 1,300 stocks are lower, and you got about 1,000 stocks which are higher. So just a bit of a turn. Need to be watchful from here on. But let's get into that discussion as far as the railway sector is concerned, guys.
Absolutely. So this is the railway sector that we're looking at, which has had a very, very strong run, right, in the last many weeks and months. But in the last few days, there's been a bit of a correction. How is the sector expected to perform in FY25? What's the order book outlook? What is the opportunity that railways companies can cash in on? We have Subodh Jain, who's the former member of the Railway Board Engineering, and E.B. Rao, the COO of Kernex Microsystems. Gentlemen, morning to both of you, and thank you for joining us on the show. Mr. Rao, I want to start by asking you about what is the order book currently that Kernex Microsystem has. What is the demand environment now in the entire ecosystem, and what do you see as the way forward?
At present, Kernex Microsystem have 600 crores order book, and the projects are ongoing. And anticipated in short time, 6,000 kilometers train pollution avoiding system tenders upcoming. And there is a very good prospects for TCAS system, because Railway Ministry decided to implement at the fastest rate possible.
So this 600 crore order book is for your company, right? For Kernex Microsystems?
Yes, it is Kernex Microsystem.
Okay, and when is the execution expected to be? I mean, how much will you execute in FY25? What would this mean for your revenue growth as well, if you can help us with that?
You see, this year now we have completed milestone 1 and we are expected to complete milestone 2, and this project has been divided into 4 milestones. Right. So we are in the completion of milestone 2. Within months' time, it will be completed, and project completion date is September 2024. We are planning to achieve those targets.
Okay, got that, sir. Well, let's get in Mr. Subbu Jain as well into the conversation. Hi, Mr. Jain. Good morning, and thanks so much for joining in. If you could tell us what is the current total outstanding orders from the railways, and give us a brief idea about the execution period as well.
The outstanding orders about which sector?
For the railways.
Locomotive.
Yeah. You could break it up for us, sir.
Say, if we see the locomotives are in 3 parts. The locomotive, wagons, and the Vande Bharat train sets. So, it's in the public domain. Vande Bharat train sets have been awarded 2 contracts. One to RVNL and Russian company JV, and another to BHEL and Titagarh wagons. They have 24 months for the prototype approval. Time, I think about 15 months are still left. Other than that, Vande Bharat today are being manufactured at ICF, where electrics are being supplied by the Medha. So that Medha will continue. This order is, I think, some 400 coaches type. I will not guess. I don't have the exact figure right now with me. So whatever Vande Bharat we are seeing today, they are coming from ICF with the support of Medha. And the Vande Bharat which have been tendered, they are of a different specification. The speed potential is more, and there are certain more advancements in those Vande Bharat. That we can see in the service maybe about 2 years down the line. So right now, the orders which have been placed, I don't see that it will survive unless somebody fails. It's okay for next 10 to 20 years. I don't think that there will be space for any new player. Because
so is it fair, sir, is it fair to assume that a lot of the orders now that will be given out will be mostly to the larger players? So basically the
orders are already given out. What was the planning for Vande Bharat for next 5 years, the introduction, those orders are already given out. Yeah.
Okay. What is the average size? And going forward, any of the new orders, can you tell us what is the average size of the new orders that will be given out? Will it be much higher than what we've seen previously?
For a thumb rule, a Vande Bharat train, 16 coach train is 160 crores. So 400 train sets was announced in the budget. Once prototype are approved, these 2 firms have been given order, they have to be given substantial orders to sustain the production. The RVNL will produce in the railway workshop in Maharashtra somewhere, and Titagarh wagon will produce in the BHEL facility and a Titagarh facility. So these are capital intensive works. You cannot, they are not off the shelf things that today you give order to X and tomorrow you give to Y. So once we have given orders to 2 companies, we have to give them time to develop themselves. I don't think that it will be right to bring in a new player unless one of the 2 fails.
Okay. All right, Mr. Jain, giving orders is fine. I want to understand whether the industry is equipped. Is there adequate capacities? And how long does it take to build further capacity since there's such a big scope of work in the next few years?
Yeah, that is a good comment. In fact, railways have been experimenting with these things. We brought in LHB, we brought in the AC locos, the modern locomotives. The method is very clear. First, we bring in where there is an import content of the order of 40 to 50%. And then as the market grows, as the Indian domestic industry responds, then the ancillaries are developed, and finally we achieve about 90% of indigenization. It takes about 15 to 20 years from the past experience. Future may be faster because now the government policies are such that we may do make in India very fast, but still it will take about 7 to 8 years to bring in about 80% or 90% of indigenization. Certain import content will always remain in the rolling stock sector. So industry will respond. I don't think no reason that industry will not respond, because these are high margin business, and they are highly specialized manufacturing. But in the past, industry has responded. We are producing the LHB coaches now indigenously. They are almost 100% indigenous, and it is all domestic, all glass and composites and all, which we never thought that will be manufactured in India with so good a quality. But now we are almost international quality. In fact, the objective and dream is that we should be able to develop the industry so that we can export. That is why the capacity being ordered is much more than what domestic market can sustain.
Okay. All right. Mr. Jain and Mr. Rao, thank you so much for joining us and, telling us about the railway sector and how things are shaping up right now. Well, moving on, we will also be talking about Biocon Biologics. Remember, the company has sold its Indian formulation business to Eris Life Sciences for 1,240 crores. We're joined by the MD and CEO of the company, Shrihas Tambe, to discuss the contours of the deal and more. Mr. Tambe, can you give us first the rationale, right? What is the reason for selling the India branded formulations business to Eris Life? Is the supply arrangement with Eris exclusive only for the Indian markets? And are there any restrictions you would have with such an arrangement with other branded formulation players in India?
Yeah, I think the first thing is that I would like to say that this is an excellent extension of our earlier relationship with Eris Life Sciences, which we announced in November of last year, where we are now further building on that strategic commercial collaboration with Eris Life Sciences. Now, what we are doing in this relationship, in this deal that we've just announced, is we are further expanding our reach to patients in India using the capabilities that we've seen with Eris Life Sciences commercial field force capabilities. Biocon Biologics will, of course, remain committed to this entire market, the patients, given that we will continue to manufacture and supply our high-quality biologics to patients in India. So I would look at this as a very complementary collaboration between two existing partners and building on a relationship that allows us to really deliver on that ambition of reaching 1 in 5 insulin-dependent diabetics in the country. And I think that is really what this has been about.
All right, but sir, can the supply arrangement be terminated or discontinued by either of the parties, or are they bound for 10 years?
Yeah, I think the important thing to look at in this thing is that there is it's not a restrictive arrangement. What we are looking at is more an enabling arrangement, an arrangement where we are looking to expand our commercial reach using the Eris Life Sciences strengths in commercialization. So it does not prevent us from working with others, but it's certainly these particular brands that we have commercialized, and you would have known Insugen and Basalog have become very familiar names in the Indian industry, particularly in the diabetes space. And these are both products which have more than 100 crores in revenues. These would be, of course, exclusive to Eris Life Sciences. So the current brands and the business that we've got would certainly be exclusive to Eris Life Sciences, which we want them to commercialize and bring it to the leading position that it deserves to be.
Got that. Has the company, with this stake sale, exited the entire India formulation branded business?
Yeah, again, I would like to clarify, we've not exited anything. In fact, we are further strengthening our position here. We, as I said, and we've announced it as well, that we continue to supply, manufacture, and we'll be committed to growing the Indian business along with using a commercialization partner like Eris Life Sciences. Now, of course, Eris Life Sciences will have the rights to commercialize these exceptional brands that we've built over the years. And you can see that the value that we've been able to monetize in the brands, which is 1,242 crores, reflects the huge potential that these brands and the business that we've built over the years has. So we're not looking to exit anything. We're very committed to India. We're very committed to patients here, and we will be looking to strengthen our presence along with Eris Life Sciences, who will essentially represent a far stronger commercial reach than we had, given that they have a bigger portfolio beyond just the biosimilars.
So what will the 1242 crore rupees be used for? Is it for debt reduction? What's the total debt on the books for Biocon Biologics? If you can help us with both the structured and the unstructured debt, and how does it change the balance sheet?
Yeah, at this point, the way I would look at this really is that we should view this as a more strategic collaboration, which has allowed us to monetize the value that we've created. And it allows us, more importantly, to invest in the business to go forward. Yes, we can discuss the net to EBITDA ratio. Clearly, it shows that there is a lot of potential in the business, because on a forward-going basis, it has certainly given us a lot of value. There is value that the buyer sees in this, which reflects what we've been saying all along. On a valuation perspective, it has given us 3.4 times the revenues that we reported for this segment in India and 18 times the EBITDA, which tells you that it's been a very strong potential that we've been able to realize for this business. And whether we use these proceeds just from one way to the other, I would focus more on seeing how can we use these, the monetization of this business to strategically grow the vision that we've set for ourselves in the years to come.
Well, could you please share details on that 10-year supply agreement? How much can Biocon basically make from it?
Yeah, I think that is a little speculative in nature, but I build on what we've been discussing, and Eris Life Sciences have probably said in the public domain already. Clearly, both partners have seen huge potential and huge opportunity in this. What we were looking at was the commercial reach. Both Insugen, Basalog, just to name a couple of brands that we've commercialized today, have over 10% market share. We believe that there is an opportunity for us to grow both these brands and the other products as well significantly. I would refrain from giving specifics, but there are numbers that Eris Life Sciences has indicated over the next 3 to 4 year horizon, and I would encourage you to look at that and be very supportive to see how we can grow this market in India.
Mr. Tambe, the US FDA has classified your Malaysia plant as OAI. What is the status of remediation there?
Yeah, so we've, in Malaysia, we continue to supply commercial products, particularly our insulin glargine to the United States. We have, of course, had approvals from all other authorities across the world, including the European authorities, which is EMA, and we continue to supply that. We do have, at this point in time, the OAI status there, and we are working with the FDA to see how we can navigate that and recategorize or reclassify that.
So what is the likely approval timelines for insulin aspart now, given the outstanding issues at the Malaysia facility? Do you expect any delays over there?
We've already responded with all the CAPA actions. We've put in place a very comprehensive CAPA plan. We have also engaged the services of reputed international third-party consultants, experts who've been in this space for several decades. And they've also provided a very positive report in terms of what we've done and how we've enacted since the observations, and that has also been submitted to the agency. I would like to reiterate, we are in conversation with the agency. And we are looking forward to moving this as quickly as we can. But it would be unfair to comment on behalf of the agency as to when we would be able to get to approval.
Well, there was a CRL issued in February 2023, I think, on cancer drug Avastin bevacizumab. Has the company replied to it? And is there any possible approval timeline?
Yeah, and if you've referred to our earnings call as well, I think the concern there has really been that we've not been able to get the agency to come over. I think the agency is looking to schedule the pre-approval inspection to our India location, to our Bangalore location. There is no outstanding information that we need to provide at this time for them to review. At this time, we've sent all the information that was required, and the agency will look to schedule this inspection. So unless that pre-approval inspection gets scheduled, which is a necessity from a regulatory perspective for all biosimilars and biologics drugs, we basically await their plan to come over and inspect us.
Okay, appreciate your thoughts. Thanks a lot for joining in. Let's take a quick break. On the other side, Nitesh Thakkar will join in for some technical trades. Stay with us. Welcome back. Well, the market is not looking good at all. The Sensex is now down 400 points. The Nifty is down 136 points. So once again, we're back to our losing ways, as we've seen in the last few days. Mitesh Thakkar joins in for a quick tech check. Mitesh, do you think this could escalate further? Because it's not looking good. The mid-cap index is now down 1%.
Good morning again. I think eventually it will. What I'm not sure whether it will happen immediately, because 21,950 remains some kind of an important support pivot. If you look at the last 4 weeks of data, I think you will find that on an hourly closing basis, we tested that level multiple times and we bounced back from there. In fact, on Monday itself also we had an intraday low of 21,905, but the hourly closing was closer to about 21,965, 970, and then we had the bounce back yesterday. So I think, what we've done is taken marginal profits off the table. Let's say 25% of the shorts have been booked. But the sense that eventually I think we'll break below that. So the directional bias is on the negative side. On stock side as well, I have a sell on REC. That's a stock breaking below key support areas. So keep a stop at 458. Look for a target of 430 here. And also a sell on Bharat Forge, which is also turning negative on the short to medium term charts. Sell here with a stop just above day's high of 1125. Look for targets of 1060.
Mitesh, I wanted to review on a couple of stocks. One is HDFC Bank. We had mentioned at the start of the series that for the initial part, it will have support because of that rejig that will take place, which will get done by today. What's your view on the stock? HDFC Bank has popped up to around 1,450 and it's been fairly stable after underperforming. What are the levels you're looking at this one?
So, Nigel, I think, one, it's been stable because it had a big fall and then it's trying to consolidate. Now, I'm wanting to see if the stock has got strength to give a fire reversal, which, given the fact that the general market is turning weak, will be a slightly difficult task. But till it crosses and closes above 1470 on a daily basis, I think the immediate view is that it will be sideways. Only above 1470, once the closing happens, you can look at some kind of a short-term up move with higher targets of 1545, 1550 on the upside. Otherwise, it will do a range of about 1470 to about 1400.
The oil marketing stocks, right? I mean, HP was down almost 10%. It's down about 8.5% now. It'll come up on your screen. 461 is where HPCL is now trading at. So the pressure there is quite large. The other ones are, of course, also down. BP is down 5% and IOC is also down about 4% or so. So for now, I think the view from CLSA working out, I mean, at least this is the first hour and a half, they were a little more negative in terms of what this price cut means. Others have been more sanguine, saying, the cut is, markets will look through it as we kind of go along. HP is already recovering as well, so keep an eye. But the Election Commission has released the electoral bonds data shared by State Bank of India following the Supreme Court's directive. The data includes details about donors, their contributions, and the parties that redeemed these donations. Hormuz is here with some names. Hormuz, morning.
Morning, Prashant. And 98 donors there combined that the list have been shared by the Election Commission of India, and 23 of them accounting for more than half of those donations. So we filtered them down to parties that have donated more than 200 crores or more, and some big names in that list. I'll start off with some names that are the top two. Top two are some unknown entities there. One of which is Future Gaming and Hotel Services. That is the one that has the highest donations of over 1,368 crore rupees, combines to around 11% of the total amount donated. They are involved in the business of lottery and hospitality services based out of Coimbatore. That is the name that is coming up as the top highest donor in that list. The other name, the second one, is the interesting one, that is Megha Engineering and Infrastructure. And they have donated around 966 crore rupees, which is around 8% of the total donations. Now, its website says that it is the third most valued unlisted company in India as per the Hurun list that was released in February. We cross-checked that, and it is part of the Hurun list with a value of around 67,500 crore rupees. And interestingly, it also is the promoter of Olectra Green Tech. It has a 50% stake there in Olectra Green Tech, and as we speak, Olectra shares are also down 4%. The company is involved in the business of infrastructure, power, irrigation, and many other businesses, and it is based out of Telangana. So Megha Engineering and Infrastructure there. The other name emerging is Vedanta, 400 crores of donation there, 3.3% of the total amount. As we all know, metals mining is a conglomerate there. Vedanta, the Anil Agarwal-led company, 400 crores donation there. The other name emerging, now some other big names there. Haldia Energy, which is a RP Sanjeev Goenka group company, that has donated around 377 crores or 3% of the total donation. donation amount, and it is involved in the power business. So they're another big company of another big conglomerate. SL Mining and Industries is the next one. Now that is an Aditya Birla Group company. 1.8% of the total donation, 224 crores donated as of now. The company is involved. It is the largest iron ore mining company and producer of noble ferroalloys, according to its website. SL Mining and Industries there. The other one, Western UP Power Transmission Company. Now that is a related entity of Megha Engineering and Infrastructure, as we just highlighted. So that has also purchased around bonds worth around 220 crore rupees. So the combined total there from Megha Engineering and Western UP comes up to around 1200 crores, and that is involved in the business of power transmission, 1.8% of the total donations there. And lastly, Bharti Airtel, 198 crores of total donation and 1.6% of the total amount donated as well. So quite few big names, but two of the biggest donors are unknown entities. Back to you.
Okay, thanks a lot for that. Let's slip into a quick break. On the other side, we'll get chatting with Rajesh Prasad, the Senior Executive Director, CBRE, and Anuj Puri of Anarok Property Consultants to put focus on the Mumbai metropolitan region redevelopment, as reports suggest that Maharashtra government has cut the premium for redevelopment of cooperative housing societies. More on that coming up. Well, let's focus on the Mumbai metropolitan region redevelopment. The news reports say that Maharashtra government has cut the premium for redevelopment of cooperative housing societies. To talk more on this and the real estate sector outlook, we're now joined by Rajesh Prasad, the Senior Executive Director at CBRE, and Anuj Puri, the Chairman at Anarok Property Consultants. Gentlemen, morning to both of you. Anuj, I want to start with you because, redevelopment in Mumbai is a huge opportunity, right? Some reports are indicating that there is a 30,000 crore opportunity that we're seeing in terms of the redevelopment size in the MMR region. Tell us a little bit about that and what do you see as the potential over the next couple of years?
So first of all, a very good morning to you and your viewers. It is absolutely a phenomenal opportunity. Mumbai residential itself is 50% of the India's residential. So you can well imagine every year there is nearly 185 lakh crores of new homes that are sold. So the problem in Mumbai then comes out is where is the land? How can we continue to grow the land if that is the kind of velocity of sale and nearly 50% in terms of value of new residential being sold only just in the MMR region. So one of the things is the redevelopment that has come up, which the government has done a fantastic thing on the redevelopment. This is largely the old societies. Just for your viewers to understand, the old societies, which have been in place for 15, 20, 25 years. There is an additional FSI that you can build on it. The building is very old and obviously there are no facilities in those buildings. So the Maharashtra government has given this option that you can redevelop the entire society and take advantage of the additional premiums to be able to go high rise. And, initially I was not very hopeful that the scheme will pick up. But what I have now seen is very good quality developers, whether it's Rustomji, Rahejas, Mahindras, number of these large developers, listed and unlisted, getting into this space because this is a very profitable business for the developer and yet at the same time really beneficial to the occupiers because they give their old flat out and they're rehoused elsewhere by the developer and then they get a much bigger, newer flat in exchange for old flat.
Got it. So that's how redevelopment works. We understand that. But you said it's much more profitable. Can you tell us the margins on these redevelopment projects? Are they much higher than the traditional projects?
Yes, they are much higher. The reason for that is because you're not paying for land. As a developer, you're not really paying for land. You are paying for the additional premium that you are buying and you're spending the money on the cost of construction. And you're also spending the cost of construction for the existing occupier on the homeowner because the homeowner is not going to pay his share of the cost of construction. But if you look at overall, if you were to buy the land and build it up, the profit margins are between 20 to 25%. Here, the profit margins are between 25 to 35%.
Okay. All right. Gentlemen, morning, Anuj and Rajesh. Just a basic question, Rajesh, to get you into the discussion as well. You heard Anuj, of course, very bullish on this entire opportunity. And by the way, we've had listed companies like Mahindra Life Spaces come on the program over the last many months and actively talk about this opportunity. It's a full-fledged sort of initiative now to look for these redevelopment societies, etc., in Mumbai. Rajesh, is there a minimum kind of threshold under these rules which have been specified? A number of years only after which a project, a development can be redeveloped, a society can be redeveloped? And are there any other operational issues or this is now all streamlined and good to go? Your thoughts?
So, that step that you mentioned, which the government has taken, which was flashing on the screen right now, as Anuj also mentioned, it's a very positive step because most of the stock that we're talking in residential going forward, I think the future is more on the redevelopment side because Mumbai is geographically constrained with water on 3 sides. On minimum threshold, normally, I think we are talking about larger societies, which are like 25, so, it's generally we're talking about, 10 acres plus societies, and, the government is trying to see what more they can do at their end to try and bring in more supply so that there's a fair bit of balance achieved with the demand because, the demand is at an all-time high when we're seeing in residential. So yeah, there is a concerted effort which the government is putting in, and this latest step is definitely a step in the positive direction towards it.
You're saying that builders will not be, only beyond 10 acres it is viable for builders or because, Yeah.
See, the larger developers, when we talk about, like Anuj mentioned, right, we are seeing all the big boys get into the game. Or if you recall earlier when we used to talk about redevelopment, it was normally the mid-tier or the smaller developers that they were opting for redevelopment. But with now very limited development opportunities, right, we are seeing the big boys, the institutional developers, the developers from South, like Puravankara, Prestige, they are getting into the redevelopment game. And from whatever conversations we've had, there has to be a certain size and scale, for them from a management bandwidth and a financial wherewithal standpoint for them to get in for it to be viable.
Okay. Anuj, comment on this, because we are talking about record high registrations in Mumbai every other day. But how much of it is coming from redevelopment? Because usually it's connected to higher demand in a particular market, but a lot of it is coming from redevelopment. What is that number?
So it is not that much at this moment in time, because this redevelopment really has picked up, I would say, in the last 18 odd months. It does take a long time before the project is available for sale, because the redevelopment mandate is signed between the developer and the society. But by the time the society vacates it and the building comes down, it's usually 12 to 18 months. It's unlike a clean, clear plot of land. So my thought is that you will see next financial year, the society redevelopment supply hitting the market. This financial year is minuscule that has hit the market, although a lot of deals have been done, but they were not vacant land parcels. And by the time, they've got vacated, it's taken that much time.
Okay. And how much is the new supply? Can you give us a sense of how big the redevelopment market would be right now in Mumbai, or the opportunity?
So I'll divide into two parts. On the redevelopment, one was the SRA, which was the slum rehabilitation. And, that scheme, we did not see any quality developer really go into it in a very large way. There were some quality developers which went in, but not really meaningfully. In this society redevelopment, we're genuinely seeing a number of these good quality developers, because a lot of these societies are actually South Mumbai based. So whilst I agree with what Rajesh said is 10 acres, but in many of these South Mumbai residential redevelopment societies, the land parcels are much smaller and the viability is very high. So if you were to look at the total value terms, my thought is that over the next few years, nearly 15 to 20% of your new supply will come from redevelopment of societies. And in terms of value, this may go up to 25%.
Okay, got it. Before we let both of you go, I wanted your thoughts on the other big news flow that came in the last couple of days, right, on fractional ownership of real estate, where SEBI also is now seeking to regulate and organize this entire piece, the fractional ownership piece. Anuj, your thoughts first on what kind of potential you see here, and is there enough transparency in the sector already?
So, fractional ownership was going on for some time. I think SEBI has done a great job that they allowed it first to go on for some time, and now they've come out with regulations. It is in a lot of demand by the smaller investors. So, if I'm a small investor, maybe ₹1 lakh I want to invest, I can't buy real estate. I can buy stocks of listed developers. I can buy REITs. But what else? This is where the fractional ownership is going to really impact, and it will attract smaller investors who do want to play in the real estate. So clearly a very nice direction. Had been in the business for some time. We were not getting into it because we wanted this to be regulated first. And we are delighted that now SEBI is coming. You will see institutional players now get into this frame.
Okay, so SEBI is coming, so now institutional players will get into this frame. Rajesh, I wanted your thoughts on it, because there are some issues with fractional ownership, right? One is, of course, it's not regulated. The other one is it is illiquid if you compare it to REITs, and the investment is also high. There's a minimum ticket size that you have to pay of, I think, 10 lakhs. Do you think it will get enough traction despite SEBI, coming in and trying to increase transparency in the sector?
In fact, with SEBI coming in, I personally believe that there will be more traction, because that will give a lot more comfort and confidence levels to investors, to go for it, because now it's regulated, right? And one of the biggest challenges that we've seen in fractional ownership is, as you said, when it comes to exit, right? The exit is very complicated, right? And that's where all the regulatory, bit and the governance, once it steps in, it will enhance the confidence levels, and you'll see more people opting for fractional ownership. As I said, the canvas of target audience is so much more larger when it comes to investing in real estate, if you're talking about fractional ownership.
Sorry, we're jumping topics here, but since we have both of you with us, Anuj, this entire, in Bangalore, right, recent headlines on water shortages, etc. From a property sector perspective, what does it mean? And this has been one of the fastest growing real estate markets. Will we see, by the way, the city is now imposing water curbs, water usage, etc. So these are pretty, it's the reality, but these are also, of course, these could deter future home buyers and people who want to set up sort of businesses or take office space, etc. If this is the direction and the situation is not addressed immediately, what's your take on the matter? Yeah.
I 100% agree with what you're saying is, the development, real estate development will now get into serious sustainable development. I think for the longest time, we've been talking about sustainable development, but it has really been largely words. On the office side, it had picked up because the occupier wants sustainable development buildings. They want platinum rated buildings. So hence recycling of the water, etc. was done. But on the residential side, the home buyer is not sophisticated as yet to be able to ask. But is the situation, if it continues the same, going to impact real estate? 100% it will impact real estate over a period of time. So it will need to be addressed very quickly. Bangalore is a very attractive city, and you cannot have this problem, continuing, because it will deter a lot of the office occupiers, as a result of which the real estate market.
Okay, all right, gentlemen, thanks a lot for joining us and talking about some of these hot topics in the real estate space. By the way, it is curtains down on Bazaar, but don't lose sight of the markets looking very, very ominous at the moment. Below that 22,000 mark on the Nifty, it's getting worse by the minute. The Sensex is now down 460 points. So we leave you with that screen where there's a lot of red. Chart busters coming up next. Stay tuned.
The market corrects after a strong start. The Nifty slips below that 22,000 mark as all sectors trade with losses. The broader markets enter sell-off mode again with a cut of nearly 1.5%. Oil and gas, pharma and autos lead the decline today.
OMC slump after announced a 2 rupee a litre cut in petrol and diesel prices. Brokerages, Citi and MK say the stock price correction could be a good entry opportunity.
Biocon slips after Biocon Biologics sells its branded Indian formulation business to Eris Life Sciences for 1250 crore rupees. Biocon Biologics management tells CNBC-TV18 that the deal is an extension of their earlier deal with Eris and their brands will be exclusive to Eris Life.
Paytm surges as the National Payments Corporation approves the third-party UPI application license. Brokerages also issue positive reports on the stock. Hello and welcome to Chartbusters. It's a Friday morning, but as we speak, well, the markets have taken a bit of a U-turn. We're trading in the red now. And the problem is the broader markets. When we started off trade for the first 30 minutes or so, you had more number of stocks that were advancing in comparison to declining. That's done a U-turn, and that explains why we have all the indices that are up for you on the screen that are trading in the red. Hey, Mangalam.
Hi, Nigel. You know, it tells you that yesterday maybe could have been a bit of a relief rally that we saw after a big pounding that we saw in the markets over the last few trading sessions. And today the selling has resumed. The question is what happens towards the second half of trade and more so in the next week as well, because we opened fairly well. Even the broader markets, were outperforming the first 15-20 minutes of trade before they did that bit of a U-turn, and now the sell-off has been a little vehement. We're currently at the low point of trade with a cut of nearly 650 points in the broader markets itself. The oil marketing companies, we've been speaking about them being weak, but the PSUs, they've begun to sell off once again. We've had BHEL, which is down 5%. At the low point is also BEL. We've seen some cuts for names like PFC, REC, IOC. All of them, especially the PSU basket, is currently under pressure. So good time to get in Manas Jaiswal for a quick check on the market. Manas, back below that 22,000 mark once again. Where do we go this time? Because yesterday we did